Hello everyone and welcome to our webinar, Australian Accounting Standards Board Guidance on the Voluntary Tax Transparency Code. I'm Tony and I'll be your moderator today. Your presenters today are Karen Payne, CEO of the Board of Taxation, and Kris Peach, CEO and Chair of AASB. Karen has been a member of the advisory panel of the Board of Taxation since 2010. She was appointed to the board in May 2015. Kris Peach has extensive experience in accounting standards setting. She has previously served on the Australian Accounting Standards Board as both a member and as the Deputy Chair and as a member of the Australian Urgent Issues Group. Today's session will be facilitated by Angus Taine, Content Specialist from Walters Kluwer. Throughout today's webinar, you can submit questions via the Questions tab at any time, and we'll have Angus posing the questions to the presenters. I think we're ready to begin, so I'll hand you over to Karen.
Thank you, and thanks everyone for taking the time to spend a little time reflecting on the Voluntary Tax Transparency Code, and in particular the AASB guidance material that's come out. I think it's a great opportunity to get some shared reflections from both the board and the Australian Accounting Standards Board on what are the objectives and the key areas to understand in terms of implementing the code. So my role is really to provide a bit of background and context. The board was requested by the Treasurer some time ago to investigate how we might develop a tax transparency code, and the board's code was released in 2016 by the Treasurer and was endorsed as part of the budget process. But so just kind of reflecting on why was the code developed, I think there are a number of drivers and a number of reasons. Firstly, obviously there has been a changed community perspective around taxation and the transparency of corporates around their tax affairs. So in part it was responding to those community concerns. It was also hoped that the code would change or drive rather cultural change. So in particular, the board did not want to adopt a mandatory code. Of course, we recognise that a mandatory code would likely result in a transparency measure that was perceived by corporates to be a compliance tool, that it would become a kind of a check the box, a process operation, whereas the board had ambitions that the adoption of the Voluntary Tax Transparency Code, and in particular what you disclosed, what level of detail, how you disclosed it, would become very much a discussion that took place at the board level and took place with senior management. So we were hoping to change corporate's attitude towards tax transparency in particular. And then finally, another reason rather was that we saw that it could improve the tax debate. There's obviously taxes in the headlines more and more nowadays. Whether you're paying your fair share of tax is increasingly becoming a topic of conversation, and so there was an opportunity, we thought, to improve the tax debate. Fair to say the board's had strong support from business and associations, including Corporate Tax Association and Business Council of Australia. So moving then on to educating the community, there is clearly a role in the Voluntary Tax Transparency Code to improve the level of education, and importantly to improve the comparability between different corporates, and in part what particularly Part A of the code is seeking to do is to address those concerns around how do I compare one corporate's effective tax rate to another. So no doubt Kris will pick up that theme. And then finally, we were concerned that we wanted to target the non-expert reader, that is the non-tax technical expert. And so providing information through tables, through kind of plain English was a key priority for the board. So then moving on to who should disclose, and we can probably move through some of these later slides a bit more quickly, because they really just provide the framework for what Kris is about to talk about. Who should disclose? Well, there's two parts to the code, and depending on whether you are a large business, which means you've got turnover of more than Australian dollars 500 million in Australia, or a medium business, that is, you've got turnover somewhere between 100 million and 500 million. So large businesses are encouraged to adopt both parts A and B, medium business encouraged to adopt part A only, but obviously it's a voluntary code, so in particular if there's something about your tax affairs that would be useful to try and position your role, your corporate's, your organisation's role in the community and your contribution to taxes in the community, then it's kind of up to corporates to choose how and what they might look to disclose. And in particular, we left a lot of flexibility around grouping so that you could choose the level of aggregation, recognising in particular if you're part of a stapled group, there may be you may have a different way in which you choose to disclose your information, and if you're part of a global group, how you might choose. So all of that is flexible. It's a voluntary code, and the primary reason why it's designed that way is to encourage corporates to actually think about what is the message that they want to put out into the community, and then and what's the best form to put that out. Then moving on to disclosures required, and again I'll kind of rush through these a bit because I think they're themes that Kris is going to pick up. So obviously Part A of the code is designed to pick up financial information. It's about a reconciliation of accounting profit to tax expense and income tax paid. It's a calculation rather of your effective company tax rate. And again, keeping in line with the flexibility theme, you can present that in whichever way you choose. You might seek to make it part of your financial statements. You might choose to put it in a standalone report, a taxes paid report, or a corporate social responsibility report. So I won't delve into that financial information too much because no doubt Kris is going to pick that up in her part of the presentation. Then moving on to Part B, this part is recommended by the board at least to only apply to large business, but again I'd re-emphasise if you're a medium business and you think it's useful, then I would encourage you to also think about some of this more qualitative disclosure as part of your taxes paid and tax transparency report. So here we're looking for corporates to reflect what is their qualitatively, what is their approach to tax governance and tax strategy, and you'll see that theme has been adopted in some overseas jurisdictions. In the UK in particular, the requirement to report your tax governance and your tax risk approach is a kind of a mandatory obligation in that jurisdiction. Your tax information about your related parties dealings, and this is an area where there has been a lot of debate. There are some sectors of the community that would like to see country by country reporting as a mandatory disclosure. The board actually gave that some consideration and concluded that it would actually be better if there was a more qualitative statement, because that information, whilst it's useful for revenue authorities like the tax office, is not so informative for the rest of the community. So that related party dealing, again, the board thought could be a more qualitative description about how you seek to price related party dealings. And again, making sure that it was in terms and terminology that would be understood by, non-tax specialists. So I won't focus on that too much. Moving on to the Catalogue of Signatories, if you have a look on the board's website, you can see total transparency about who has indicated their intention to sign up, and I just wanted to give you a bit of insight into this process. So you'll see at present there's about 95 organisations, 52 of which have published their tax transparency reports and 11 of which are private companies. So moving on to some statistics. Overwhelmingly, the adoption of the Voluntary Tax Transparency Code has been picked up by Australian listed public companies, and no surprise there. I guess they are used to thinking about the disclosure of information for their stakeholders. The board's transparency report has been adopted by 75% of the top 200, the ASX top 200, which is a pretty good statistic. But if you think more broadly about what is the data that the tax office are publishing around corporates, and they're publishing information on more than 1,500 large and medium-sized corporates, the statistics start to look a little weaker, and in particular the area where there hasn't been such a strong response is in the private sector and foreign-owned companies. There are some reasons for that, I think. In particular, foreign-owned companies have, Australia is just one part of their corporate group, and indeed it takes time to get a measure like this to go through the various internal procedures in order to elevate it to the board, not just here in Australia but globally, to get it on the agenda. So I think the board has we still have hopes that we'll get more foreign companies signing up. You may have also seen recently that Aldi's agreed or indicated their intention to sign up. So there are foreign companies who are coming online, and as I said, I think it's going to take more time for them as opposed to an Australian listed company. And I think the private companies are probably not so used to dealing with transparency in the way that public companies are, and so the response rate there has not been as great. So moving on then to the process, again, I really just want to make clear that you can indicate your intention to adopt the code as a first step to the board without having done or published anything. It's then a process for the group to put together their tax transparency report, and you can indicate, in whatever form, you can do that in whatever form and for whatever year is appropriate and consistent with your, notification of intention to the board. And then once that report has been published, the third kind of step in the process is that the report is published on a tax office website, and there's links on the board's website to that tax office hosting site as well. Very importantly, the tax office are not auditing or reviewing the accuracy of these reports. They are merely providing a hosting function. But hopefully you can see from that process that you don't have to have your report ready to go, ready to be published before you can signal your intention to adopt it. And indeed, there might be, 12 months in some cases, at least 12 months before that the published report is completed and on a public website. So signing up to the code, next slide, is really a simple process. You simply contact the board. There's lots of contact details on our website. There's an email address, and you can either send us an email, send us a letter. You can give us a call. We're happy to take all forms of communication for those wishing to adopt the code. And that's it from me. So hopefully that's a quick insight into the process. And I will now hand over to Kris to take you through the guidance material that the AASB have recently published to talk you through those.
Thanks, Karen. That was a very useful introduction, and if we just reflect on one of the poll results, I think 90 people had indicated that they were going to be signatories, Karen, so it sounds like almost everybody that signed up is on the webinar. So this section is actually just going to take you through what we have in our draft guidance. And I'd just like to highlight that this is in fact draft guidance. And the reason for that is that this is a little bit of a step outside of what the AASB normally does. So we thought it was very important that we gave everybody a chance to tell us whether or not this guidance is actually being helpful. So you will note that it's open for comment until 28th of February because we did want to try and have people use it for 30 June if at all possible, but also acknowledging that many entities will have different year ends. So we're looking forward to seeing what the benchmarking for 30 June will show in terms of how people have adopted the guidance or not. So just a couple of key points in the way this guidance was put together. It is based on the fact that everybody is going to at some point have lodged financial statements with ASIC. And generally speaking, that means that all the recognition and measurement requirements of Australian accounting standards will have applied to the underlying financial information. But one of the key things that came out for us as we worked through this project and as we understood more what the Board of Tax was looking for is around the effective tax rate disclosures. So what you find is that in accounting standards we've actually got a definition of an accounting effective tax rate. So what that means is that when you come along and do a TTC effective tax rate, and I'm just going to use ETR for a shortcut terminology, that means that in some cases that's going to be different. And if it is in fact different, it means it's a non-IFRS ratio. And that means that ASIC's Regulatory Guide 230 will need to be complied with. So we have been very careful in putting this draft guidance together to make sure that we're actually consistent with RG 230 as well. So that might explain for some of you why there's so much information about effective tax rates in this particular piece of guidance. So one thing I will say, the Board of Tax has been very flexible in terms of how and where information can be provided. And I think that's going to be one of the key decisions that you'll need to make upfront and fairly soon. So some of the factors that you might like to think about when you're deciding whether or not you want to put your information wholly within the financial statements, wholly outside, or perhaps in some cases some inside and some outside. The key considerations will be, do you want that information audited? Because if it's in the financial statements, then it may actually be audited almost by default. And if you don't want it audited, then perhaps it's easier to have the information outside. As we mentioned, you need to be particularly careful about Regulatory Guide 230. So even whether it's in or out of the financial statements, you need to be careful about making sure there's no undue prominence of alternative numbers, etc. But I think one of the biggest considerations is duplicate. So particularly with the reconciliation of tax expense and tax paid, a lot of that information is already in the financial statements. So it may well be that it's just easier and less duplicate, it's an interesting word, to put it into your financial statements. And it will be interesting, that will be one of the things that will come back, and no doubt the Board of Tax will be interested in as to where people have dissemination. Regardless, what we would suggest is that there is good cross-referencing, particularly if you're putting some in and some out. In order to claim compliance with the code, you need to be able to demonstrate you've complied with all aspects of it. So it's very important that a user is able to locate the information that ensures you are actually complying. So one of the things that we wanted to do with this guidance was to make it consistent with the framework for preparing your financial statements. So what we did was we said, okay, let's think about the important things. So that's the information must be useful to users. The Board of Tax has given you a good steer, and so really saying when you give this information, you need to make sure that it's faithfully represented. So we don't want it to be unbalanced. You need to be telling the complete story, and it needs to be done in a neutral way. We also want it to be verifiable. Even if you choose not to have it audited, we wanted to make sure that it was capable of being audited or reviewed. And a couple of other key things is we want it to be understandable, so we want the information that you're providing to be clear and concise. We do want it to be comparable, both internally over time for your entity, but also across entities and across industries. And lastly, it does need to be relevant. And as part of that, we have given you a new definition of materiality. So it's using concepts that you should be familiar with, but making them specific to the purposes of this information. So it's saying information will be material if a user needs to understand or wants to understand how that piece of information reflects on your tax processes. So it is specifically targeting to the tax information. So that does mean that materiality for this information is going to be different to what's in your financial statements because it is for a specific purpose. So I'm not sure whether there's any questions on that, but you might want to just have a little bit of a think about that because I think that's one of the most interesting areas is how do you hone in and target what is the most important information for users. So moving on, the tax effective rates were the ones that we found the most interesting in trying to put this guidance together. And there's a couple of key things to note here. So the TTC effective tax rate is actually in lots of instances going to be different to the accounting effective tax rates. So the Board of Tax is being very clear that they're only looking for company tax expense. So that's taxes under the Income Tax Act. However, from an accounting perspective, some of you may include other taxes, such as the petroleum resource rent tax, in what is classified as income tax. So if you're in that space, then you will need to provide a reconciliation from how you've got from your accounting income tax expense through to what is going to be in your TTC effective tax rate. And of course, I should have mentioned that the effective tax rate is just tax expense over accounting profit. Now, accounting profit also is a little bit interesting because accounting profit for the purposes of the TTC effective tax rate can be accounting profit in accordance with all accounting standards, or it could be using an alternative profit number, and that alternative profit number might well be something like underlying profits. So we might just move to a little poll here just to get some idea. So the question that we're going to ask is, should TTC ETRs be calculated using accounting profit in accordance with the accounting standard, underlying earnings, or should entities be able to choose which of those are appropriate for them?
Kris, just while people are answering that poll question, we do have a couple of questions come through.
Yep.
A couple of them might be a little more detailed than you want to deal with at the moment, but I'll ask you anyway. You can just postpone the answer if you want to. The first is on prior period assessment adjustments. Paras 31 and 73 refer to these being prior period errors. but in practice these are adjusted through profit and loss as changes in estimates. And the attendee wants to know, will this be a reconciling item between reported profit and loss and the TTC disclosures?
Yes, that's going to be the case, that there will in fact be a reconciliation depending on the materiality of the amount. So what the Board of Tax is trying to work out is what's the true tax that's applicable for the current year. And of course those adjustments relate to prior years, and so including them in your effective tax rate means that you get a little bit of a mismatch between those years. So yes, if it's material, you would expect to see a reconciling item between your accounting income tax number and what you've actually used in your TTC effective tax rate.
Mm-hmm. All right, next question is how the changes in estimates of tax liabilities under IFRIC 23 proposed to be disclosed.
So again, that number will come through in your assessment of your company tax, of your accounting income tax expense, if you've picked up an amount that's related to that. So again, a little bit will depend on what year you think it's actually relating to. So if your adjustment is in connection with the prior year assessment, again, you would have to have a reconciling item that was explaining that if it was material. Okay, so we might close the poll there. It looks like there's some very interesting results there. So if I've understood that correctly, what we're saying is 72% believes that the TTC ETR should be based on accounting profit in accordance with accounting standards. Okay, so that was one of the specific questions that we asked in trying to get feedback. So that would be very useful if we could take that through. And of course we will be talking to users to see what information they're seeking as well. So just to finish off TTC effective tax rates, the other interesting piece here is that the Board of Tax has asked for global operations but also Australian operations. And so what you might find is that for large complex entities, Australian operations will be a subset of global operations. So if that's the case, what we tried to do was give some guidance about how you could work out Australian operations, and effectively it's anything that's established under Australian law is what we would consider to be the entities that you need to be considering for Australian operations. And again, we're very interested in your feedback on whether that's helpful or whether we need to try and do something else in that space. So I've done it now. So one of the things in looking at our TTC ETRs, we wanted to be clear about the disclosures that you need to make because they are in fact, as we said, alternative IFRS numbers. Pardon me. So the first thing was to be clear about what your objective is. So why do you believe that you need this TTC ETR? And in particular, if you have chosen not to use accounting profit, why you think using underlying profit is perhaps a better measure to be used in that ETR. So for example, you might say we believe underlying earnings is a proxy for what we think future earnings will be, and that's what we believe we're actually providing is a better indicator of what we think the future tax expense is going to be. So that's a very important disclosure that we think that is very necessary. And then once you've clearly identified that objective, what we then think is necessary is that you explain how the adjustments that you make actually fit with that objective. We've also said you need to be very careful about making sure that you present information neutrally and with no more prominence. And clearly the calculation of the basis of the ETR is very, very important. And most importantly is some contextual narrative that explains why your accounting or your TTC ETRs differ from the corporate tax rate. Because at the end of the day, that's actually what the Board of Tax is trying to encourage you to disclose, is that you've told your story about why there is a difference and why it's appropriate that that's the case. And of course, lastly, we want to make sure that there's comparability in terms of how people can look across industries and sectors. So if we move away, and sorry, the last point just on ETRs is just making sure when you make adjustments that you're being consistent with both the numerator and the denominator. We do want to make sure that everybody's comparing apples with apples. So just moving on to the second part of the key disclosure that the Board of Tax is looking for, and we have been just looking at Part A, this is the reconciliation to income tax paid or payable. And what we're really trying to do is encourage you here to use as much as possible of the reconciliation that you do provide in your financial statements. Unfortunately, what we tend to reconcile down to in the financial statements is income tax expense. And that's a number that comprises a whole heap of different things. And I do believe that if you can use that reconciliation to properly reconcile to current tax expense, which is more likely to tie up with how much you expect to actually pay to the ATO in connection with your current year, then that's going to actually be much more useful to your users, regardless of whether they're looking at the TTC information or whether they're just trying to understand the financial statement information as well. So we have provided a number of example illustrations to hopefully help people pull out that information. But you will note that the key here is that you do need to disclose what you think is a material, temporary or non-temporary differences. So again, you need to put yourself in the shoes of your user.
Kris, sorry, we just had one question on that. Attendee wants to know if there's a good example of the TTC ETR disclosure and reconciliation in a recent actual company's financial statements that you might suggest that people could have a look at?
So I might just come back to you on that one. So we've done a little bit of a look, but we haven't sort of seen too many, and we were hoping to have a look after the guidance is being issued just to see. But we can get back to you on that one. Right. Okay, so just in terms of the reconciliation, very important that clearly identifying what components are and making sure you give good, useful explanations of what the differences are between what goes into accounting profit and what actually goes into your income tax return. Okay, now what we've just talked about is all in connection with Part A. So I'd now like to ask a question in connection with Part B. We've given a little bit of guidance, which is that overarching framework, which is in connection with Part B, but we'd like to know whether we need to give more in connection with that. So we'll just let that one go for a couple of minutes.
Kris, just while people are doing that, we had someone pop in a comment through that PwC has a publication on TTC that refers to Seek Limited that might provide a good example of the reconciliation we were talking about.
Yes, I was just checking my records and I was about to come back and say Seek is a very good example indeed. So that's very helpful. Thank you to whoever the attendee was there. Right.
And just while people are still answering that, we had one more question. This was referring back to the calculation of the TTC effective tax rates.
Yes.
Should the income tax incurred be tax payable or the accounting tax expense in that calculation?
So it's the accounting tax expense. But when you look at the TTC ETR, it would reflect what's going to be expected to be paid. So your accounting ETR will reflect your income tax expense, and your TTC ETR will reflect what you think your actual company tax expense is going to be. Okay, so that looks like we've got some good responses there. So if we close that poll, and if I've understood that correctly, it's saying 80% of you think that we should be giving more guidance to Part B. So that's very helpful. So what I'd also encourage you to do is if you could just drop us a line and let us know what aspects of Part B you might like a little bit more information on, that would also be very helpful. Okay. Right, so we'll just sort of start to bring that together. So if you put it all in place, the key things for you to be thinking about now is really deciding where and what you want to communicate in connection with these TTC disclosures. So in particular, thinking about what's going to be good for your users and what's also going to be helpful in terms of whether it's audited or reviewed. So again, as we mentioned, one of the key aspects is just making sure that your TTC ETRs are reconciled to and presented with your accounting ETR. So they do need to be in the same space and they do need to be presented neutrally, equal prominence and a clear explanation of your calculations. In connection with your reconciliations of your accounting profit, again, important to make sure that you've set out your material line items that are needed to be explaining the differences there, and that's where it also can be quite useful to be distinguishing between what is foreign and domestic. And also you will see in our illustrative examples that we've given a split between recurring and non-recurring because we think that that might be more useful for users as well. So lastly, just a reminder that the guidance is open for comment until the 28th of February. And we'd certainly like to hear from you, and I would certainly like to encourage you all to start early if you're going to be adopting the code, and certainly wish you all the best in implementing that code. So we might now open it up for further questions. Tony, Angus.
All right. Just one question so far that you haven't dealt with already. Someone wants to know how it's proposed that companies deal with negatives like accounting losses or tax losses.
So basically it will just follow the principle of what is your tax, but it doesn't really make a lot of sense to have a negative effective tax rate. So I think that one's going to be more appropriately dealt with in terms of an explanation as opposed to a quantitative number. But we have been getting that question a little bit, so I think we might end up having to do a little FAQ on that one just to help people out.
All right, and just while we're waiting for more questions to come in, I'll just let everyone know that the slides that Kris and Karen have been talking to during the seminar will be distributed to all attendees at the end of the seminar. And so far there are no more questions. So if anyone does have any questions, please do submit them. Now's your chance.
And also just to comment, we're very happy to talk to people on the way through this process. So if you do go through and you go, okay, I've now figured out I have another question that I didn't get to ask today, then please do make sure you you contact us, and so I've just put up some of the details that you can use to get in touch with us. So we will be working quite closely with the Board of Tax to finalise this guidance next year, and so we would like it to be as helpful as possible. So don't be afraid if you didn't get your question in today that you can't get it across to us. So is it...
Sorry, we just had one more question come in. Someone just wants to know, I want to clarify on the ETR. Usually we calculate it based on total tax expense, i.e. deferred and current. Are you saying that we should only use current?
So you do, no it is. So for accounting purposes, yes. So that is your company tax expense. And yes, sorry, for your TTC, yes, it is in fact current and deferred. So yes, I wasn't quite as clear as I should have been on my previous answer. But you do have an option to again explain how you've chosen what you want to go into company tax expense. So if you felt it was relevant to just look at the current things, then you can make adjustments in your TTC effective tax rates. And I think that might be a very good FAQ. We'll have a look at that one and add a little bit of extra guidance around that. So very good question.
All right, well, there's no more questions at the moment, so I'll hand it over to Tony to do the formal wrap-up. But just before I do, I just wanted to say thank you to Kris and Karen from us. It was a really useful seminar, I think, for everyone. Right, Tony?
Thanks, Angus, for facilitating today, and thank you again, Karen and Kris, for today's presentations. If we didn't get a chance to answer all your questions, we'll make sure to follow up via email or phone. To all of you, have a great day.